back to Core Investing. In this video, I will talk about a special purpose vehicle, also known as SPV. I will discuss what SPV is, how does it work in the venture capital space, and why investors use SPV. A special purpose vehicle is a legal entity that is created for a specific purpose. It is separated from the parent company and it has its own balance sheet. An SPV is often created as a limited liability company or limited partnership. It's also called a pass-through entity. It's owned by members, pass through the income to those members in proportion to their ownership. In the venture space, venture capital firms create SPV for two purposes. One, to pool money together to invest in a single asset. In this case, invest in a single startup. For example, when there is a very exciting opportunity and they want to invest in, but they don't have enough cash in hand, they can pool money together from investors and to invest in that single startup. The other reason venture capital firms use SPV is when they want to invest in a startup that is not within their focus. For example, if they focus on financial technology industry and they have a specific fund invested in financial technology startups, and there is a company in the SaaS space and they are interested, but it's not within their focus, in this case, they can create an SPV and to treat that investment as separated from their main fund. Investing in an SPV is different from investing in a fund because when investors invest in an SPV, they only invest in one specific company and they don't own the shares of the company directly. They own the membership of the vehicle, and the special purpose vehicle invests in the startup. So in this case, investors are indirectly investing in startup. Investors again own the membership interest, whereas investing in a fund is investing in many different companies. So the fund manager can decide what companies to invest in, when to invest in, and the investors typically do not have any say in terms of picking a company. The reasons investors invest in SPV is one, access. SPVs typically have a lower minimum, sometimes start as 1K, 5K, 10K, depending on the deal. And investors can get access to startups that they are interested in. The other reason why investors invest in SPV is that it gives investors the opportunity to learn about the underlying startup. So investors know the underlying startup before making investment decision. There are also risks associated with investing in SPV. For example, the only purpose for the SPV is to invest in a single asset. The risk is lack of diversification. If the underlying startup fail, that means the SPV will fail as well because the SPV does not have any other activity. The other potential risk is that investors normally do not have the right to manage the SPV. Investors rely on the fund manager to invest in the startup. Alright, thank you so much for watching. If you liked the video, please subscribe. Bye.